Hey everyone, Andy here from Luminary Wealth, back again with the quarantine beard in full effect. Now, last week I put out a video on taking coronavirus related distributions from your retirement accounts. Now, I want to propose an alternative, and that's loans from your employer sponsored retirement plan. So, that is your 401k, 403b, etc. Now, this does not apply to IRAs. Now, before diving in, I just want to make a quick point that dipping into your retirement accounts, whether it be a 401k or an IRA, should be considered a last resort. You should evaluate all their options before doing that. Look at your emergency fund. Consider reducing all your non essential expenses and maybe even look into a home equity line of credit. I think these are all things to consider before dipping into your retirement account. But we're in a pretty unique situation with this pandemic where a lot of people don't have any other options. So if you're in that situation, then a loan may be right for you. So let's dive in. So your retirement plan with your employer may allow you to take a loan from your account balance. Now, they're not required to allow for this, so you're going to need to check with them or look in your plan documents to see if this option is available to you. But typically, you can take up to 50% of your vested account balance or $10,000, whichever is greater, up to a maximum of $50,000. So let's say your vested account balance was $60,000. You could take up to $30,000 out as a loan. Now, with the CARES Act, these amounts have been slightly modified. So now you can take up to 100% of your vested account balance up to a maximum of $100,000. So back to the scenario, if you had $60,000 in your vested account balance, you could take that whole amount out as a loan. Also, under the CARES Act, any payments on that loan that would typically be due in 2020, you can defer those for up to a year. Now, the terms of the loan are somewhat dependent on the plan, but typically you have 5 years to pay back that loan. There are some exceptions, but that's the general rule. And you do have to pay interest on the loan, but any interest you pay just goes back into your account. So you're essentially paying yourself back. Now, one of the benefits of taking a loan versus a distribution is that there are no taxes and penalties on a loan. Now, if you don't pay that loan back, then it'll be counted as a distribution and you'll have to pay taxes and potentially penalties on it. But even with the distribution under the CARES Act, like I talked about last week, while the penalties have been relaxed for 2020, you still have to pay taxes on those. I think one of the biggest advantages of a loan versus the distribution is that requirement to pay it back. So with the distribution, there's no obligation to pay it back. Under the CARES Act, you have 3 years to pay it back, but typically that's not the case. With a loan, you're required to pay that back, and behaviorally, you're more likely to put that money back into the account. But a couple more things to consider before taking a loan. If you leave your employer before paying it back, you may be required to pay it back in a very short period of time. Otherwise, it could be considered a distribution, and you would therefore have to pay taxes and potentially penalties on it. Also, with a loan, you're paying that money back with after-tax dollars. So not only are you replenishing the account with money that's already been taxed, but when you take that money out at retirement, you're going to get taxed on it again. So there's some double taxation there. And finally, anytime you take money out of a retirement account, whether it be a 401k or an IRA, you miss out on that growth potential on the amount that you took out. So the more you take out, the longer you keep it out, the more you're missing out on those earnings, and the more you're going to have to put back to fully bring yourself back up to where you could have been had you not taken the money out. That's not to say that a loan or a distribution is necessarily a bad idea. The CARES Act expanded on these because people need it. And there are a lot of people in a unique situation where they really don't have another option. So if that's the case for you, talk with your advisor and see if a loan or a distribution is right for you. And in the meantime, stay safe. Have a good week.